The Reserve Bank of India sprung a surprise yesterday when it struck an unexpected dovish tone and refrained from tinkering with key policy rates. With this, the repo rate was left unchanged at 4% and the reverse repo rate at 3.35% for a 10th straight policy. The Monetary Policy Committee also decided to continue with the accommodative stance as worry over growth continues to weigh. The RBI projected 7.8% GDP growth for FY23, which is slightly lower than the 8% to 8.5% GDP forecast made by the Economic Survey 2021-22. Governor Shaktikanta Das said concerns are arising from the uncertainties related to Omicron and global spillovers. Nonetheless, no immediate threat to liquidity availability and hardening of interest rates resulted in bond and stock prices surging. The S&P BSE Sensex printed 460 points while the NSE Nifty surged 142 points to end at 58,926 and 17,606 levels respectively. In the money market, 10-year government bond yields cooled off over 1% to quote at 6.7%. But analysts fear it may be too early to cheer. According to Aurodeep Nandi, India economist and Vice President at Nomura, RBI expressed a very dovish outlook for inflation for FY23, forecasting it at 4.5%. This comes despite higher oil and commodity prices, growth-supporting fiscal policy, continued economic normalization, and a distinctly hawkish Federal Reserve. This suggests that RBI is likely to remain behind the curve until macro circumstances warrant a shift of gears. Deepak Jasani, who is head of retail research at HDFC Securities, too believes the RBI's latest monetary policy may raise concerns that it is behind the inflation curve.
Reading the fine print of minutes of this MPC's meeting would provide more insights into MPC's mind for not narrowing the policy corridor between the repo rate and the reverse repo rate. Though the intent of the RBI to support the recovery in the economy in the face of disruption due to Omicron variant is commendable, the fear now will be whether the RBI will fall behind the curve, having maintained the easy monetary stance longer than most other central banks have.
Assuming a normal monsoon, the RBI projected retail inflation for fiscal year 2022-23 at 4.5%, with Q1 FY23 forecast at 4.9%, Q2 at 5.0%, Q3 at 4.0% and Q4 at 4.2%. But analysts worry that inflation risks, especially from fuel prices, remain a concern. If inflation rises more than expected, markets will have to realign quickly, they say. As regards money market, movement in yields will have to be tracked going forward.
The market was expecting some announcement or action to tackle the huge borrowing program. Given the sovereign bond inclusion in the global index is uncertain in terms of timing. Perhaps the announcement on this front would be expected in April meeting at a time when H1 FY23 borrowing calendar is released.
Aditi Nair, chief economist at ICRA, continues to expect the 10-year yield to cross 7% in April 2022, once the FY 2023 borrowing program kicks off. The RBI also enhanced the debt VRR limit from 1.5 trillion rupees to 2.5 trillion rupees yesterday, expecting higher FPI inflows into India's debt market. While this could be an interesting support to the bond market, analysts say the inflows will have to be tracked as the existing limits haven't been breached. Overall, the RBI's dovish policy will provide near-term support to both equities and bond yields, but global headwinds remain key risks. On Friday, reaction to the fine print of the policy, Q3 results, and global markets' reaction to US inflation data will be the key triggers.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.